Welcome, everyone. This is episode 40 of the Brandon Adams podcast. I have with me Jared Dillian. Jared writes a daily newsletter called The Daily Dirt Nap. He has a podcast called the Be Smart Podcast, and he's the author of Street Freak and All the Evil of This World. Jared, how's it going today?
Pretty good. Thanks for having me.
So I listen to your podcast fairly frequently. I'm curious how you stumbled on the short form podcast. You're doing frequent podcasts of maybe 12 to 15 minutes each.
Yeah, I mean, before I had the podcast, I had a radio show. I actually had a kind of a small nationally syndicated radio show, and it was unsuccessful. We had to shut it down. It was losing money. But we switched to a podcast, and we were working with a radio consultant. And he's like, look, the popular podcasts nowadays are actually the short ones, because people get in their car, they drive 15 minutes somewhere, they can listen to a whole podcast. It's self-contained. And, he said that's kind of the new trend. And all the podcasts I've been doing so far are just me. I haven't had any guests. I'll have guests at some point, and those will be longer. But, for the rest of them, it's just me, and I just do a 12-minute podcast.
That's interesting, because most people take their cue from Joe Rogan, right? He's the most successful podcaster, and he's someone who lets interviews go 2-3 hours. I suppose it's a different demographic in the sense that maybe people listen to Joe Rogan with a beer in hand or something like this, and a financial podcast maybe consumed at work or something like this.
Yeah, I don't know. I mean, we'll see if it works or not. There are some guests that I want to have on, and there's like a local guy in town. I used to have him come on the radio show every Friday night, and he's sort of an everyman character. He's like a fix and flip contractor, and we just BS, and like it's huge amounts of fun. So I'm going to start off by having him on. We're going to record something next week, and I don't know when it's going to go up.
So I was a big fan of your book, Street Freak, and I do, while I have you on, want to get into market outlook. And I remember in the first chapter of your book, you talk about your philosophy that markets tend to move in the direction of max pain. Many people have pointed it out, but having followed your Twitter feed for a long time, I know this is central to the way you think about markets. What do you view as the max pain trade at this moment?
Yeah, it's a good question. I don't know when you're publishing this, so maybe it's going to be stale, but this is Friday the 18th of February, and we're headed into the weekend, and there's this imminent invasion of Ukraine by Russia, and the market's been selling off pretty hard going into that. So I look at everything from a sentiment lens, and I'm trying to figure out where positioning is. Are people short going into the weekend? If there's no invasion over the weekend, are people going to have to cover on Tuesday after the long weekend? So that's the type of stuff that I think about. I think about sentiment and positioning. I'm positioned a certain way. I had a tweet the other day where I talked about sort of my, 2 to 3 week forecast, where, I said, I think stocks are, they probably have 10% downside, and I think bonds are going to rip, and all that's based on sentiment and positioning, just basically people, trades getting too crowded.
The other part of that tweet is you said oil down and gold up. You also claimed that you're going to be the pomp cheerleader for gold on the way up. Gold needs some cheerleaders because it's been a tough ride. I share with you the optimism on gold, but it's been a brutal run.
Well, it has and it hasn't. I mean, from the highs of 2060, like we really only got down about 15%. I mean, in terms of drawdowns, that's actually not that bad. It feels a lot worse, mostly because gold hasn't responded to a whole bunch of catalysts. You know, it hasn't responded to inflation. It didn't really respond to the pandemic. It hasn't responded to budget deficits. So, you know, that's why people are so frustrated with it. But just in price terms, like this correction, which has lasted a couple of years, it's not that bad, you know. I mean, Bitcoin's down a lot more, you know, Bitcoin's down 50% or was, you know.
And on the sentiment level, I remember last summer you wanted to be bullish on gold, and you were long-term bullish on gold, but you were short-term bearish based on what you were seeing from sentiment. And in particular, there were days where there was slightly disappointing Fed speak and gold was down, say, $40, and you made the observation that would it have been up $40 if the Fed speak had been gold favorable, and you were posing it rhetorically because it was clear that the answer was no. And so the sentiment has changed more recently, and that's kind of what gets you quite bullish at the moment.
Yeah, and I noticed a change in the price action. Like, you know, you'd walk in every morning, 8:00, 8:30, they'd slam it down $20, and this was happening like every single day. And then a couple of weeks ago, there was a change, and you know, those gold smashes stopped. And you know, you probably heard of Mark Minervini. He's the guy that, you know, got lambasted because he didn't know what Upstart was, like on CNBC. But he's a super smart guy and an excellent trader. But he always said that you want to own stocks, or not just stocks, but any asset that acts like a tennis ball, like it goes down and it bounces. And like 3 weeks ago, gold started acting like a tennis ball. And I noticed the change in price action. I said, well, something's different, you know. So I had a decent sized position before, and in the last week or two, I've made it much larger.
Yeah, I'm a long-term gold bull who's super favorable on gold at the moment. And when I say it's been a tough ride, it hasn't been a tough ride if you look at the price chart. As you point out, there haven't been crazy drawdowns. It's been a tough ride psychologically since, let's just say, mid 2019, where gold was not too much lower than it is right now, maybe $100 to $200 lower than it is right now. But over the period of that time, you've had everything that a gold holder could ever dream of, right? $4 trillion deficits and infinite money printing and all of this. So you would have expected that it would behave more favorably. And if you put it gold in terms of like what everything else has done, right? What the cost of real estate has done and this sort of thing, it hasn't looked so great.
So my friend Brent Donnelly, who used to work with the Lehman, you've probably seen him on Twitter. He said something awesome the other day. He called me a gobbler, you know, like a hodler for Bitcoin, but I'm a gobbler for gold. And I have been gobbling gold since 2005. I mean, that's when I started building a position. So I've held it for 16 years. And my thesis was that, you know, why hold gold instead of stocks? Well, I said, well, I think gold's going to outperform stocks over a period of decades. And it ended up being about a push. If you go back to 2005, the performance of gold is about equal to the performance of stocks, which is kind of interesting. Yeah, like, you know, over the last 100 years, gold has returned about 4% a year. But since 1971, it's returned a lot more than that. And you have these periods of time in history where, you know, gold, the appreciation of gold is just much faster than stocks. So I think we're in one of those times.
Yeah, in Dalio's framework, gold tends to do very well when you're in the middle of the crisis, which did hold during the great financial crisis. Gold had its big rally point when stocks were doing quite poorly in the depths, really, of the financial crisis. And part of that might be people are seeking an alternative. And then part of it clearly is that people see the policy changes, the aggressive money debasement that's likely to come, and they jump into gold. I wanted to ask you a bit about the recent correction in growth stocks. Obviously, some reversion in the value versus growth factors was likely to come. We have had somewhat severe corrections in growth. You started your career, I think, at the tail end of the dot-com bubble, or just as the dot-com bubble was popping, if I'm recalling correctly.
99. Yeah, 99.
And I wonder which popping of a growth bubble will see fewer people make money on the short side, that one or this one. I say that because it's always interesting, like how far the growth factor can go when it really runs, right? How far a bubble can go. And of course, in the dot-com bubble, some people made money shorting stocks on the way down, but not many people, because anyone that had the inclination to short was likely short in 1998 or 1999 and had their face ripped off before they could materialize any gains. And this one is somewhat similar, where people that have had the taste for shorting growth stocks as part of their portfolio, maybe running some sort of long short book, have had a tough time staying the course because what happened with the growth factor was so explosive.
Yeah. It's funny. I'm up on my screen. I got a chart of Facebook, and, Facebook has just been hammered. I really think I think this rotation from growth to value, not on a long-term basis, but on a short-term basis. I forget the statistic, but it's like 70% of NASDAQ stocks are down more than 50% or something like that. Like, I kind of hesitate to like pile on and short stuff here, because I think we're closer to the end of that trade than the beginning. Like, what are you playing for? Are you playing for down 90%, down 95%? Like, I don't, this trade is at least more than halfway over. Let's put it that way. So I think there's going to be sometime in the next maybe couple of weeks, you're going to have a chance to play a pretty big bounce in some of these growth names. They're starting to look interesting, actually. So,
yeah, and some sectors like biotech are very cheap and seemingly a very good opportunity. By my way of looking at things, I mean, you have, I think something like high 20% of small cap biotechs are trading below cash. So not that that's necessarily like a compelling buy, but there must be some compelling buys in there.
Yeah.
So I would say that relative to many market commentators, you're not prone to maybe you share some of my pessimism. That's not fair to say. You have a broad historical lens, and you're skeptical of markets that are galloping. You're careful, right? Conservative. And I have a question. You're clearly like of the Generation X, right? And I would like put myself squarely in that generation.
Generation X.
Yes.
Ultimate Generation X, yes.
And I've noticed that Gen X, there is a shared psychology, and there has been a shared life experience. And there's clearly a different way of seeing the world between Gen X and Gen Y and then millennials. A lot of the sort of techno optimism, it's a rarer trait among Gen X. Have you observed this?
Yeah, I mean, Well, I would say as a generation, Gen X is pretty skeptical and also pessimistic. I mean, the first movie I ever saw in the theater was The Empire Strikes Back, and in The Empire Strikes Back, the bad guys win.
Right.
That screws you up for life. You think the bad guys win. So like, what does that do to your psychology? So that's my generation. But I actually, also as a generation, I think that Gen X is are better investors than millennials or boomers. Boomers are extremely rich, but they got killed in 2000. They got killed in 2008. They're going to get killed again if they haven't already. They're terrible risk managers. Millennials are all in crypto, which is or is not going to work out. I mean, Gen X, being skeptical, like I think that they make better investors. Would you agree?
Yeah. Well, it's a survival instinct, right? I think some of it is the latchkey generation or whatever left to tend for themselves more than previous generations. It's a survival generation, a generation that's skeptical, doesn't really expect institutions to work very well, and positions themselves to survive. Whereas the younger generation is more optimistic all around
and has more faith in institutions. Yeah.
The crypto thing is interesting because obviously the sort of founding principles of crypto are anti-establishment, anti-institution. And I've always been skeptical of crypto myself, mainly because I always have the belief that governments will do what they need to do. And crypto is so obviously against the interest of governments that at a certain point they will stamp it out. This has been my belief for years. It hasn't materialized. I've made a lot of mistakes not being in crypto, but I've always felt that governments need to inflate to survive what's coming. They need to control their own currency. And crypto, if large parts of the population start transacting and storing their money in crypto, that threatens government's ability to inflate, and they can't have that and have to stamp it out. But it hasn't materialized yet.
I agree with your thesis, but there are periods of time where the government does the right thing. So from about I would say 1982 to 2006, we had positive real interest rates, right? And basically the fiscal and monetary authorities were actually, we had something close to a balanced budget, maybe deficit to GDP of about 2 or 3%. So this period of time that we're in right now, where what you said about how the government needs to inflate to survive, like that is, I hate to use the word, but it's kind of transitory, that will pass. Okay. And it might not pass until we go through a lot of pain, but there will come at some point in our lifetimes where we will go back to being fiscally responsible. It will happen. I just don't know when.
Well, I would argue that it's going to be a long time because demographics put a lot of pressure on budgets, given that medical expenses are inflating. Whatever we think CPI is, historically, medical expenses have gone up about 7% per year faster than that. We have large promises in Medicare, Medicaid, Social Security that are going up as medical expenses go up and as the population ages, and the population is aging rapidly. And we have, for now, the political will to continue the programs at the promised level. So I see sort of large deficits is baked in the cake for a long time.
5-10 years, but let me put it this way. If inflation gets to like 20 or 30%, which is possible, we're going to get to a point where we're gonna reach a sentiment peak. People are gonna get fed up with it, just like they did in 1979. Like that people will reach their limit when it comes to this nonsense. So I just, like I said, I don't know when that is. I don't know if it's in 5 years, 10 years, whatever, but you're probably right. It's probably a long time. But I think, before I die, I think we'll see it.
Yeah. I mean, inflation on that level in the current environment it would be almost immediate political crack up I kind of think that I don't see inflation getting there, but I feel like if you do have a very unexpected outcome and for whatever reason, money velocity sort of runs away from us and the psychology changes where people just try to convert financial assets to real assets at every opportunity and inflation starts galloping. I think if that happens, that's just like all of the political pressures that have been building for a while, like the social and societal pressures, they just sort of pop off rather than we find a way to deal with it through Fed policy and fiscal policy. It's sort of my belief. If inflation ever gets there, we've sort of lost the ability to deal with it through existing institutions, kind of.
Well, I'm an optimist.
I don't think it gets there. But you never know, right? These things are unpredictable.
It's that Winston Churchill quote. He said, Americans can always be counted upon to do the right thing after exhausting all other possibilities.
Yeah. And well, here's the way we've been doing things for a long time is that we've been somewhat okay with traditionally inflationary policies because it's only led to inflation in asset prices, not in goods and services prices. And if we start to get high inflation in goods and services prices, then that's when you're starting to feel the societal cost of inflation, like and really, to some extent, the reason that our policies have been tolerated is because it's been so good for asset prices and politically powerful own a lot of assets. And that's just sort of the way our society has been going. But if we have sustained goods and services inflation, that's so bad for the lower income segments of the population that I feel that the political pressures become really severe.
Yeah. Yeah.
And I've been thinking back a lot to the market action of 07, 08. And I know that you were deeply involved in the markets and saw firsthand what was going on in real estate there. I was deeply involved. Later, I was the main research assistant for Michael Lewis on The Big Short and studied the era quite intensively.
Cool.
Yeah, it was fun. And
the Front Point guys are good friends of mine.
Nice. Yeah, I was involved in all of the research on the collapse of the CDO market. None of the character studies. All of the character studies were Michael. I was all on like facts, timelines, all of this kind of thing. And so I've been thinking back to that period quite a lot because one of the interesting tidbits from that time is that you had commodities running at a seemingly unlikely moment, right? Like oil reached its peak in July of 08. And house prices were declining in most markets by mid 06, and by summer 2007, the problems that real estate was going to pose for the financial system was already evident. You had countrywide sort of collapsing in August 07, and it was it was sort strange in retrospect that oil was reaching its peak in the summer of '08. But I think that that commodities are a bit of a choke point for the economy, and one area where the true cost of irresponsible fiscal and monetary policy can assert themselves. Like, it's possible that we get a real run here in commodity prices. I know your short-term forecast for oil is lower, and I'm honestly a bit agnostic about oil. But if we happen to have a galloping of commodity prices here, it would create a feedback loop in prices, which could be quite damaging.
Yeah, and you started this off saying that, basically the market does what caused the most pain to the most amount of people, and that's exactly what's going to happen, because it's going to cause the most pain to the most amount of people, especially food. Agricultural prices, I think, are going to go up a lot. I mean, they've been going up very quietly for the last 3 or 4 months. But you get into the summer and boy, it could be interesting.
So your view is, and I might be reading too much into your recent tweets, but your view is that the economy is naturally slowing at this moment. Is that correct? Like, you think that, hold the inflation picture aside, you think that economic activity is tending to slow in 2022? Is that right?
Yeah, I think so. Mostly because we pulled forward a lot of consumption in 20 and 21. And 2022, we're going to have below trend consumption. So I think GDP is going to be lower this year. I think it's going to be probably below 3%, maybe 2%. We're not talking about a recession here, but the economy is not going to be as hot as it was the last 2 years. I'm actually seeing it in my newsletter business. 2020 and 2021 were huge years for me. And starting off this year, it's been slow. So,
do you find a correlation in general? Obviously, you had it in 2021 with the S&P as a whole, but do you find a correlation in general there, that people, when they're speculating in stocks and doing well because the trend is going up, they're more likely to buy products?
Yeah, absolutely. Yeah.
So you think that the economy is naturally slowing. Does that also lead you to believe that the Fed is making a policy mistake, or rather,
well, I wouldn't call it a policy mistake. I mean, they have to do what they have to do. The optics of having zero interest rates with inflation at 7.5%, like, they absolutely just have to hike rates. But it is true that they're hiking into a slight slowdown. But I don't, we were pricing in 7 rate hikes as of last week. It's a little less than that this week. I would be surprised. That's kind of an understatement. I would be very surprised if we had 7 rate hikes this year, 1.75%. I actually think they go 25 in March. I do. I don't think they go 50. So there's a lot of divergent opinions within the Fed. I mean, everybody kind of thinks that, okay, it's Bullard, it's Powell, like everybody, is panicking about inflation. But you have some people on the Fed like Mary Daly, who I don't know if she's a voter or not. I don't think she is, but she's not, she doesn't want 50 basis point rate hikes. She's talking about 25 in March and then being on pause for a while. So, and she's not the only one. So there's a lot of voices within the Fed, and I don't really see any scenario where we have 7 rate hikes this year.
I agree with you. Part of why I agree with you is just the history of it. It turns out that the Fed is one of the most successful jawboning institutions of all times. Like if you look at the history of the past 10 years or longer, if you look at futures curves and you say do exactly what you're doing now, say the market's pricing in 6.5 rate hikes or what have you, and then you look at what actually happened, the market has been consistently surprised for a decade. The market has, simplistically speaking, shown a strong tendency to believe Fed guidance, which then turns out to not be true. Like the rate hikes never materialize. Yeah. And that's been true for a long time.
Yeah, I've seen those charts.
So on the one hand, the Fed situation is that they need to do something because CPI is printing at 7%, and the Fed will still make the argument that CPI is likely to go down. I have some sympathy for those arguments. But they still have to increase rates a bit because it has proved more persistent than they were guessing, say, a year ago. So on the one hand, the Fed needs to tighten policy. On the other hand, we're running big deficits, and there's no sign that deficits are going to decrease anytime soon.
Yeah, I know where you're going with this. And I hear this all the time, oh, we can't hike rates because of interest expense, because of this debt burden. We can hike rates a fair amount before the interest expense gets to be a problem. Like,
I don't worry about interest expense necessarily. I worry about the fact that the Fed has been the market. Like they have no institutions or individuals are wanting to buy bonds at prevailing rates. And it used to be that our trading partners were taking large bits of it. They don't anymore. And it's really the Fed, right? It's not buying it directly from Treasury, but it might as well be because it's buying it from institutions soon after they buy from Treasury. And without the Fed as the buyer, I don't think anyone is in a hurry to take their place.
Yeah. I mean, the Fed is like 30% of the mortgage market and whatever percent in the Treasury market. I mean, we've seen yields back up a bit. I mean, one of the things that's keeping rates down is really just relative value with the rest of the world. I mean, boons are at 0% and JGBs are at 0%. And, there's a lot less negative yielding bonds out there, but still, like, the US is the cleanest dirty shirt. We have 2% yields, which is pretty attractive. So there's really no scenario in which we can have 4% yields and the rest of the world is at 0, right? Because everybody will come in and buy US treasuries. So, yeah.
I appreciate that argument. And you think that the Fed, you think that they're credible this time, fairly credible in their hiking regime?
That's an interesting question. Is the Fed credible? I don't think they want inflation to go down. I think they want inflation to go down, if that makes any sense. Right. I don't think they really want to do what it takes to get inflation back down to the target. And what it would take is Fed funds at 7, 8, 9%, like that they're unwilling to do. So, regardless of what they do, whether they take Fed funds to 1, 1.5, 2, something like that, we're still going to have these big time negative real rates, and it's still going to be inflationary. So these guys are not Paul Volcker.
Why would it take Fed funds rate being that high? Because what if people just like lose a bunch of money this quarter, right? What if Bitcoin's down? stocks are down, and through the wealth effect, we get a natural slowing of things. Isn't that enough without having
No,
rates move much?
no, it's not. You need positive real rates. You need positive real rates. Yeah.
So you think the wealth effect channel, which has clearly, to my eyes, been sort of part of this inflationary boom, you think that if we had steep losses across all asset classes, that would not be enough to tame inflation?
I mean, it might get CPI from 7 to 5, but it's not going to get it back down to the target. You know, you need
And
positive real rates.
is is that based on a view about inflation coming from the supply side versus the demand side, or you just
No,
think?
that's based on a view of history. I mean, how we tamed inflation in the early 80s was by taking Fed funds up to levels where we had positive real interest rates, and we had positive real interest rates throughout the 80s and throughout the 90s and throughout the 2000s, which kept inflation low. So ever since 2008, we've had negative real interest rates, which is what contributed. Negative real interest rates are the worst thing in the world, causes huge misallocation of capital, causes distortions. Like, if you want to look at the worst times in history, it's when you have negative real interest rates, including World War II.
I have sympathy for that view. It's interesting though. I'll have to contemplate this point more. I've not considered the idea that you could have sort of a destruction on the demand side and still have galloping inflation. Do you think um, do you think that at this moment the Fed, more than in recent history, might be okay with markets tanking?
A little. I mean, there's a lot of discussions about the Fed put, where the Fed put is and what strike. Um, I think that the Fed views these asset price declines as welcome. I think they view it as welcome. I think that the Fed kind of was the last to figure out that we had something resembling a bubble, okay, in stocks. And is fine with seeing it go down 10%, is fine with seeing it go down 20%, 30%, probably not. 30% probably not. That's probably where they step in.
Interesting. Yeah, you think back to say December 18 when seemingly Powell was okay with the markets walking down 20%, but then as soon as it happened, there was a quick pivoting of policy. Um, this time it seems like they have the tolerance for a bigger declines. I agree with you. The number is somewhere around there, about 30% or so.
Yeah.
Um, there's been talk in financial Twitter about how maybe passive investing and the increased relevance of option markets and so forth has created more feedback loops in financial prices than ever before. And we saw a bit of this in March of 2020, where declines were seemingly begetting declines in the absence of government intervention. Do you think that kind of thing is why the Fed might be concerned or tending to step in at 30%? Like they just would fear some sort of out of control debt deflationary spiral? Or why do you place a Fed put at that level? Because that's kind of the level that might bring us back to historical norms or something.
Yeah, my whole theory around the Fed is that they're a government institution, and they're not driven by the profit motive. They're driven by embarrassment. Okay. It's all about politics, and it's all about saving face. And, the thing about the Fed hiking rates now, if you notice, they did not take action until inflation became a political concern. They were fine with it at 3%. They were fine with it at 4%. They were fine with it at 5%. It was only when inflation got so high that all the polls, Pew and Gallup and everything, that said, If you're a voter in 2022, what is the number one thing that you think about? And everybody is saying inflation, and you have Democratic lawmakers calling up the Fed, telling them to do something about inflation. They didn't do anything until it became a political concern. They have 400 PhDs at the Fed, and everybody in FinTwit, back in 2020 was saying, look, we're handing out the stimulus money, the child tax credits, the PPP loans. We're printing all this money. This is going to cause inflation. Everybody knew this, and they did not act until it became a political concern. So likewise, the Fed is not going to act when the market declines until people start complaining about it and people start blaming the Fed for crashing the market. So they are late to everything because they only act in fear of embarrassment.
I like that view. I think that has a high explanatory power. It is true that Powell, based on his time log, spends more time chatting with congressmen than any Fed president that I could think of. He probably would not say he's swayed by these conversations, but he's definitely having a lot of conversations with congressmen. So changing tone, a lot of the reason why your newsletter and your Twitter is so popular is because you are a very entertaining writer, and you had a tweet today that mentioned that you've been writing your whole life in middle school, high school, and so forth. What, in your opinion, are some of the best fiction and nonfiction in the sort of Wall Street genre? And how early did you know that you were going to write a Liar's Poker-esque tale?
I kind of got recruited to do that book. So the story is, I was at Lehman and I was writing stuff every day. I was writing this market commentary on Bloomberg, and it was really good stuff. And there was a guy at my firm who was forwarding it to a literary agent. So when Lehman went bankrupt, I was approached by this literary agent to write a book about Lehman. And so this was like, early 2009. So I had a meeting with this guy, and I was like, no, I don't want to do that. Like, I don't want to get involved in everybody's dirty laundry and write a book and have everybody hate me. And just, why would I put myself through all that? So about 6 months later, the guy came back to me again. He's like, come on, let's do the book. So I agreed to do it, wrote a proposal, and sold the book. And that's how I ended up doing the book. But it wasn't my idea. It wasn't my idea at all. In terms of, like Wall Street genre, Michael Lewis's stuff is great. I think that my favorite Michael Lewis book is actually, it's not Liar's Poker. It's not The Big Short. It's The New Thing. I don't know if you ever
like that book. I like that book quite a lot. It's funny. I think about that one because, was it in The New Thing or Next where he tells the story of Jonathan Lebed, the New Jersey kid that got convicted by the SEC? Was it in New Thing?
Yeah.
I
could be mixed up, but
it was either in Next or New Thing for sure. And I believe it was in New Thing. And I think about that story quite a bit because the way Lewis tells the story is quite sympathetic to the character Jonathan Lebed. And the story was essentially that he was a rich New Jersey suburban kid, and in middle school, his dad gave him, I think, a $60,000 trading account. Now, I know it's a little crazy that his dad gave him access to a $60,000 trading account, but the story is that in his middle school mind, he thought that the best way to make money in stocks was to buy highly concentrated positions in illiquid companies and then tell everyone about it, scream to everyone you can get hold of via forums and all the accounts you can handle and stuff like this. And so that's what he did. And he turned the 60 into somewhere between 1.2 and 1.7 million. And then the SEC decided to prosecute him and made him, obviously they didn't put him in jail, but they did make him turn over, I believe, all of his profits or something like this. And Lewis's thought was that the kid was kind of a genius, and that he didn't understand why the kid would be prosecuted when so much worse misbehavior on Wall Street for people that should actually know better doesn't go prosecuted. But the reason I think back to this story sometimes is because the kid obviously hadn't studied market efficiency or any financial economics stuff. He just had the idea that stocks were essentially a marketing problem, and he was going to solve that marketing problem. And we see the same thing among less financially sophisticated people now, doing crypto and NFT and small cap like that. That's the way the world works now, the Jonathan Levitt way.
Yeah, that's absolutely true. By the way, he's probably like 30 right now.
Yeah.
Something like that.
Yeah, sure. Surely he's got some NFT projects going right now. But he was very savvy about the way that he did it. And the SEC, they defended their actions by saying that there were just a couple of lines that he crossed that they had to defend. I think it was the multiple account things were part of the problem, that no one knew who he was. He didn't have the benefit of like a Wall Street professional who's talking their own book and has some sort of platform. He didn't have a Twitter following where he could say, buy this. He had to create his audience, and his chosen way of creating his audience was through Yahoo message boards. Yeah. And he quickly realized that the best way to create some activity was to have multiple accounts that were commenting on each other. And I believe that was the line that the SEC did not tolerate. Sort of creating a lot of chat activity on his own. So that's also the story where he tells about the competition for the biggest yachts, right? And somebody builds the yacht that can barely make it under the Golden Gate Bridge or something, and then somebody else builds a yacht that's 1 foot higher, or a sailboat that's one foot higher and can go under at low tide or something like this. Quite an entertaining book. And that was when I believe Michael had just moved from New York to the Bay Area and wrote those 2 books about Silicon Valley. So do you have any other Wall Street favorites?
Gosh, let me look at my shelf here. I don't know. I mean, I've read them all. Yeah, I guess that's it.
So, you recently started a Substack. How's that experience been for you?
That's been good. I've gotten a lot of positive feedback. I'm a little surprised I don't have more subscribers. And let me explain why. So I'm getting close to 50,000 Twitter followers. I started up the Substack and I got 1,200 subscribers immediately, like within a day. But I figured, out of 50,000 Twitter followers, I could probably get like 5 to 10,000 Substack followers. I have like 2,300, and it's growing, but it grows really slow. So, I mean, this is really just like a fun project for me, where I get to write about stuff that doesn't have anything to do with finance. But I'd like the following to be bigger. So if you're listening to this, subscribe to my Substack. It's We're Gonna Get Those Bastards, wggtb.substack.com. And it's lots of fun. It's lots of fun. So
maybe it's just an attention span issue. People like the soundbite of Twitter, and there's so many high quality sound bites. People don't have the attention span anymore for
Well, the funny thing is about that is I don't think that I'm very successful on Twitter. I really hate the sound bites. I hate the 280 characters. Like I'm very good at long form writing, but I'm not very good at condensing my thoughts into tweets. And there's a lot of stuff that I just don't tweet because I'm like, it's just too nuanced to put into a tweet or even a tweet storm. Like it has to be a long form piece. So that's the thing that I struggle with.
I can see that for sure. Do you have work routines? Because your output is quite impressive. Do you have a way that you organize your day?
I do most of my writing in the morning. Um, when I get in around 8 o'clock and take care of some emails and stuff and send out my newsletter. And I'm basically writing from 9 to 12. I write for 3 hours straight. And then in the afternoon, I'm a little bit fatigued. I don't like to do much writing in the afternoon, but I still will if I have to. So that's when I just take care of business stuff or whatever.
And you're in Charleston?
Pawleys Island.
Okay. And for fun, you are a DJ.
Yeah. Yeah. Um, I've been doing that since 2008. It's a great hobby. I got a gig coming up in Dallas on March 5th. I have a gig coming up in New York on April 1st. I'm going to be playing in Palm Beach in May. Like it's huge amounts of fun, huge amounts of fun. And I'm such a geek about the music. I love nerding out to music. All my music is on SoundCloud. I record a new mix about once a month, post it on SoundCloud. Actually have a pretty decent following on SoundCloud, interestingly enough.
Music definitely seems to generate the biggest followings. If you're on Instagram or whatever, it's definitely musicians that have the biggest followings. Well, I'll have to come. I'll have to come check that out in Palm Beach. I'm in Miami, so in May I'll roll up there.
Yeah, yeah.
Well, thanks so much for the time. This was a lot of fun. And since this one is a bit timely, given all the market commentary, I'll try to put it out this weekend.
Oh, that'd be great. That'd be great. Yeah.
All right. Thanks so much.
Okay. Thanks.